November has certainly proved to be one of the more interesting months of this year. It obviously all started with the US election, and on that day we started to see equity markets fall quite sharply across the globe. But intra-month, most markets have now recovered a good chunk of those falls. Here in the UK, we've probably seen a 75% recovery of those falls, and elsewhere things have moved on even better than that. We are now focusing on one or two issues. The Greece deal is expected to be concluded possibly by as early as Monday. In order for this deal to come through, we are looking at voluntary arrangements for the banks. It doesn't sound terribly voluntary, but that voluntary it will be labelled. We're still looking at Spain and wondering if they will come to the bailout. Over the course of the last month, Spanish yields have actually declined quite sharply, and that's certainly allowed a little bit of risk to come back into European markets during that time. But of course, the biggest topic of conversation will remain the US Fiscal Cliff, which has to be agreed by the end of the year. So we have about 30 days, and already this week we've started to see markets move around a little bit on positive and negative comments coming out from various sides of that particular divide. So I expect that December is going to be dominated more increasingly by the US Fiscal Cliff talks during that time. But saying that, as mentioned, we are seeing some positive equity performances, and it's fair to note that Q4 corporate profitability, inflation adjusted, is actually proving to be close or at near record highs, and so despite all of this, we are seeing good corporate profits, and that is what's keeping the equity market, I think, in reasonably sort of comfortable form. Starting off with one chart I want to show is the Japanese stock market, and I think Japan is interesting. Lots of talk at the moment about the fact that they're now moving towards a trade deficit, a budget deficit, and indeed that the debt to GDP ratios are incredibly high, far higher indeed than we are seeing in places like Greece. But despite all of that, Japanese equities are marching on, and I think they're marching on to the tune of possible stimulus. We're seeing again this week a further package of stimulus coming into the market. Will it weaken the Japanese yen? Will this help the exporters? There are so many companies over there that rely incredibly on their export markets, that equities are responding quite favourably to the problems that they have at the centre. So this is the Nikkei, and as one can see over the course of this year, proving itself to be one of the better performing markets. I think it's always worth mentioning the bond market in Japan. This is the 10-year JGBs. And we can see here the yields that have moved from just over 1% at the beginning of this year, now down to, we can see 0.7%. So record lows on the yields there at the moment. Now, bears of Japan, who believe that we're on the cusp of something quite nasty, this is the trade that they're shorting. And in fairness, it hasn't been a particularly successful trade this year, because that's not the sort of graph that shorters would want to see on the yields. At the moment, it's in the inverse to price. But I think it is a chart for 2013 that we should be watching closely for any changes to that particular pattern. Turning back into the UK, we had the announcement this week of a new central banker for the Bank of England, and generally the applause for this appointment has been universal. I think anecdotally he will prove to be as accommodative as the Mervyn King, and so little change in terms of policy. In terms of the banks, he has demonstrated in the past that he's not afraid to go heavy on the banks. He had a famous fallout with JP Morgan's Jamie Dimon once, and so whilst he has come from a banking background, the feeling is that he will take that additional responsibility of bank regulation well. And so that is an interesting appointment. Initially, sterling did spike on the news. It's not something that really the Bank of England wants to see, a strong pound at the moment. I've commented upon this before. We're trading just above 160 at the moment, and ideally they would like to see that lower. We've had about an 8% appreciation, as I mentioned last week, recently, which has reversed about half of the benefit that we've seen in the currency depreciation since 2007. So again, we need to watch that reasonably closely. The couple of charts that I've found of interest this week. This is the Shanghai Composite. So if you started this year believing in China and China growth, it's been a very poor year in terms of the equity market. I'm not necessarily saying the two should fall in line, but the Chinese stock market has proved to be one of the worst performers over the course of this particular year and is now trading below 2,000. In fact, you'd have been far better off putting your money into Greece. Greece equities this year actually proving to be one of the better performers over that period, and that's despite the fact this week we saw 10% declines in some of their banks. But Greek equities, amazingly, are doing better than Chinese equities over the course of this year. In terms of the FTSE, this is the chart. This is that V shape that we've seen intra-month between November, but again, nudging close. And really, can we see the year-end rally on? Can we have a sort of last gasp attempt at getting through 6,000? I suspect that will be the topic over Christmas lunches this year. The mid-cap index is actually at those highs again. It's reclaimed the 12,000 level. It is the much better performing index for growth, and it's the one that I continue to want to highlight when people are talking about equity returns. And the final chart here, which I think is just worthy of some comment, is one of the biggest companies. Vodafone has been a poor performer of late. It's come down from 190, bottoming out around 160 at the moment. It's quite clear that some of the core revenue sides has been suffering in Europe. They've taken a 6 billion euro charge against some of their European assets. But this stock, for me, now the dividend is out of the way, feels like a stock that seems to have found a floor around the 160 level.